Hello and welcome to Capital Market and the Security Analysis for Ethiopia. Today we are going to see financial institution. I am Balai. Definition of financial institution. Financial institution is a company engaged in business of dealing with financial and monetary transaction such as deposits or giving a loan or taking a deposit, currency exchanges, insurance and the like. They are financial intermediaries that intermediate between seller and the borrower. That means between depositor as well as our lender. The common types of financial institutions include commercial banks, investment banks, insurance company, pension funds, mutual funds, and so on. Types of financial institution. Financial institution can be depository institution, which is taking a deposit, and a non-depository institution, which is not taking a deposit and are not allowed by legal, and depository institutions that are allowed to take deposits by legal. When we see types of financial institution in detail, depository institutions are commercial banks of any country, savings and loan associations, mutual saving banks, credit union, specialized banks. And under non-depositories, we have contractual saving institutions such as insurance companies and pension funds, and also investment intermediaries. Those are finance companies, mutual funds or investment funds, money markets, mutual funds. Let us see detail of each. When we come to depository institution to see detail, they are legally permitted to receive deposit from public, like in the form of saving, the form of demand deposits, and providing home mortgage and other loans. They include commercial banks, microfinance institutions, credit union, and the like. Depository institutions provide four important services to the economy. The first is they receive deposits and hold them in a variety of different accounts as custodian and liquidity. The second, they extend credit through loan and other instruments for borrowers. The other, they facilitate the movement of funds or payment system consisting of checks and electronic fund transfer. Number four is they invest in security also. Other depository institutions are commercial bank or retail banks. Their corporate charter and the power granted to them under the state and the federal law determines the range of their activities. Public commercial banks and the private commercial banks are existing in any country. Two types of commercial banks. The other is microfinance institution. Like commercial banks, they are provider of credit, but now tend to offer a similar range of service to those offered by commercial banks. However, the size of the loan are smaller than those guaranteed by commercial bank. The other deposit institution is saving institution. They are often described as mutual societies or mutual saving banks. They are jointly owned by the individual group who often share common bonds such as working for the same employer, being in the same profession, attending the same church or other institution, living in the same community, and the like. Saving institution like commercial bank offer saving products to retail customer, but now tend to offer similar range of service to those offered by commercial bank. They are governed by a board of directors that are elected by the member. The members agree to save money together in the form of deposit and to make loan to each other at a reasonable rate of interest. Any profit made by them are shared back with members by way of dividends or in the form of dividends. Saving institutions are known by different names around the world, such as Spanish-speaking countries, Kajas, North America, Credit Union, Australia and UK, building societies, East African country, a mutual owned saving institution go by different names in different countries. They are known as saving and credit cooperative societies or SACO or SACOs. In Ethiopia, saving and credit association. Saving institutions, as they grow and gain more capital, some have demutualized and turned into public companies, and many have applied for banking license. Example, mutual saving banks in Tanzania and the cooperative banks in Uganda, and also money in banks, so money into banks or money saving institution or microfinance changed into different banks. Merged or being taken over by large ones. The other depository institution is credit union. They are cooperative financial institutions formed to groups of people within a common bonds. They are created, owned, and controlled by the members who pooled their funds to form the institution together. Membership in credit union is not open to the general public, but it is restricted to the members who share the common bonds. Example, cooperative unions of coffee, sesame, cotton, and like. This is part of credit union. Let us come to non-depository institutions, or which is not legally permitted to receive deposits. They are not legally permitted to receive a deposit from the public. They make contractual arrangements and investment in security to satisfy the needs of investors. Those non-depository institutions include insurance companies or contractual institutions, pension funds, investment banks, which is agent banks, mutual or investment funds, the finance. Non-depository institutions, the first one is insurance companies. They are contractual saving institution which collect periodic premium from insured parties or policyholder, and in return agree to compensate against the risk of loss of life and the property. For example, for the damage of your house or for the damage of your car or other property. So you can get compensated from insurance company. They pool the small premium of the insured to pay the large claim to those who have losses. First of all, they collect fee premium and the bet pays large claim for loss. The premium payments are regular, while the losses are irregular, both in timing and amounts. The premium is paid annually, but the payments or the claim is irregular, not in a specific time. Payment is only when there is the occurrence of damage or the happiness of a damage. Otherwise, insurance company will not pay you. And in time, it is irregular, and also in amounts, it is different. The premium is small, and the amount of payment for claim is big. The other non-depository institutions is retirement scheme. There are pension which accept savings to provide pension and other kinds of retirement benefit to the employee of government units and other corporation. To meet the retirement benefits, they are long-term investors of financial assets such as shares, bonds, and the physical asset like on real estates. They can invest on real estate. Also, they can purchase different kinds of government security such as treasury bill and so on. Retirement scheme includes employees scheme, employees of an organization that are self-directed scheme, retirement through their own personal retirement scheme, and there are two forms of post-employee benefit. The first benefit is defined benefit scheme. It specifies exactly how much retirement income employees will get once they retire. Defined contribution scheme only specific or specify what each party, the employer and the employee, contribute to the employee's retirement accounts. The other non-depository institutions are investment banks. You can think of underwriter or investment banks as middlemen between the companies and the investing public that work as agents. They are financial institutions which act as agents of their clients in financial market in the exchange of financial security. They differ from commercial banks since they do not usually collect deposits and lend money. Rather, they are agents in between. This is how this company works. Bond or shares, and also capital, how capital is flow from the buy side or fund manager to corporates, and then from corporate to fund managers, bond or shares. In between, there is investment banks that sell side, the contact with the buyer side, and also contact with the corporate side. And there is in between investors that controlled by fund managers. This is how it's follow from one area to another areas. The other non-depository institution is mutual funds. They are the association or trust of public members and invest in financial instruments of corporate sector for the mutual benefit of its members. They are basically large public portfolios that accept funds from members and then use these funds to buy stock, bonds, and other short-term debt instruments issued by governments and the corporation. The other non-depository institution is finance companies. They are non-bank financial institutions that tend to meet various kinds of individual or consumer credit needs. They involve in leasing, project financing, housing, and other kinds of real estate finance. The other non-depository institution is sovereignty wealthy fund or SWAFs. These special government-owned investment funds that holds financial assets such as securities, bonds, real estates, or other financial instruments. Example: Norway government pension funds, Abu Dhabi investment authorities, for some foreign holding of Saudi Arabia's, and the China Investment Corporation, Ethiopia Investment Holding Group, or investment holding. This is what sovereignty wealthy funds. This is the end of today's program. I thank you for your views. Please, if you like my work or my teaching contents as well as explanations and the like, subscribe to my YouTube and share. Next time we will learn function of financial institution. My YouTube channel is at Balai Zaude 1986. Thank you.